In 2015, Canada's population grew by roughly 300,000 people. That was considered a strong year. Politicians cited it as evidence of a healthy, open country. A nation still attracting talent, still generating opportunity, still punching above its weight in a world of demographic slowdowns. In 2023, Canada added over 1 million people in 12 months. That is not a different point on the same curve. That is a different curve entirely. And here's what makes it worth examining carefully. Almost every traditional indicator responded the way it was supposed to. GDP rose, housing demand surged, universities reported record enrollment, construction cranes multiplied across the Toronto skyline, across Calgary's beltway, across the rental markets of Halifax and Moncton that had never seen this kind of pressure before. Banks reported stable mortgage portfolios. Government revenues expanded. On the spreadsheets that matter in Ottawa, the numbers looked like vindication. But something else was happening at the same time, in the same country, to the same people living through all this growth. Real GDP per capita stalled. Then it began to drift backward relative to peer economies. Productivity weakened. Housing costs absorbed record shares of household income, not just in Toronto and Vancouver, where it had been expected for years, but in cities that were supposed to be the escape valve. Young Canadians began leaving major cities. Some began leaving the country. Not dramatically, not in a visible wave, quietly, practically. The way people leave when they've done the math and the math doesn't work anymore. The contradiction sits there, stubborn and unresolved. Canada is growing faster than almost any developed country on Earth, and the average Canadian feels measurably worse off than they did a decade ago. More financially fragile, more locked out of ownership, more aware, in a low-grade but persistent way, that the system they were promised is no longer operating on their behalf. This is not an immigration debate. Setting that framing aside entirely is the only way to actually see what's happening. The question is structural. When population growth becomes the primary mechanism of economic growth, not a supplement to it, not a component of a broader strategy, but the load-bearing beam. What does the economy start to look like? What incentives does it generate? Who benefits from continuing? Who absorbs the cost? And once the system has been built around volume, what happens to the option of building it around depth instead? Because that option does not stay open forever. For most of the post-war era, Canada ran a model that was, by global standards, genuinely well designed. Federal immigration targets were coordinated with provincial infrastructure capacity. Energy exports funded public services without requiring aggressive taxation of a productive middle class. Banks operated under conservative mortgage rules. Housing prices rose in desirable cities but broadly alongside wages. Population growth was moderate and matched by capital formation. The country was building the roads, schools, transit systems, and hospitals that a growing population actually needed. Most importantly, productivity was doing meaningful work. Yet more output per worker meant living standards could rise even in years where population growth slowed. The economy deepened as it expanded. A country that gets wealthier because each worker produces more value is on a fundamentally different trajectory than a country that gets wealthier in aggregate simply because it has more workers. One is compounding, the other is diluting. Canada was compounding, not fast, not impressively, but steadily. Then, beneath the surface of that stability, something began to shift in the underlying architecture of what actually drove growth. Housing and finance started to claim a larger and larger share of economic activity. Residential investment crept upward as a share of GDP. The banking sector's exposure to real estate deepened. Municipal budgets became more dependent on property transfer taxes and development charges. The economy was not visibly different. The headlines still mentioned manufacturing, still nodded toward a services sector that was supposed to represent the future, but the center of gravity had moved. Once housing and the financial infrastructure around it became the dominant pillar of national economic health, the incentives of every major institution began to reorganize around a single overriding priority: keep prices stable and rising, not affordable. Stable and rising. Those are not compatible goals. The system chose one. Consider what that choice looks like from inside a bank. A major Canadian financial institution holds hundreds of billions in residential mortgage exposure. The health of its balance sheet depends on housing prices not falling. A meaningful price correction, the kind that would restore affordability for people who cannot currently buy, would impair collateral values and produce the kind of balance sheet stress that central banks spend enormous energy preventing. The bank does not need to make a political decision about housing policy, it just needs to manage its book. And managing its book means preferring a world where housing demand remains strong and prices keep rising. Now consider a municipal government in the Greater Toronto Area. Its revenues depend substantially on property taxes, development levies, and permit fees. Every new condo tower is a revenue event. Rapid population growth means more permits, more transactions, more assessments at higher valuations. The municipality has every financial incentive to welcome population growth and every financial disincentive to accelerate zoning reform in ways that would allow prices to fall. Lower prices mean lower assessments. Lower assessments mean smaller budgets. Smaller budgets mean service cuts, which are politically fatal. Now consider a federal government whose economic legacy depends on GDP growth numbers. GDP rising is good. GDP per capita falling is a story told in academic papers, not budget speeches. The incentive is to protect the headline, and the fastest way to protect the headline when productivity is stagnant and private investment is sluggish is to add people. Every new resident generates consumption. Every enrolled international student pays full tuition. The number goes up. The press release gets written. These are not corrupt decisions. These are rational decisions made by institutions inside a system that rewards this behavior. The trap is not a conspiracy. It is an alignment. Think about what that looks like in a city like Calgary in 2023. For years, Calgary was understood as a pressure release valve, a place where housing was still affordable, where a middle-income family could own a home without generational wealth as a prerequisite. Then Alberta's population grew by more than 200,000 people in a single year. Rental vacancy rates collapsed. Average rents on a two-bedroom apartment increased by over 20% in 12 months. The city's infrastructure had not been built for this pace. The people who had moved to Calgary specifically because it was affordable discovered that affordability had followed them there and then been consumed. The relief valves close one by one. When labor supply expands rapidly, something predictable happens to investment decisions inside firms. A company facing a labor shortage has two broad options. It can invest in automation and process improvement that allows existing workers to produce more output, which raises productivity but requires capital expenditure. Or it can hire more workers, especially if a larger labor pool means wages are not rising as fast. The second option is cheaper in the short term. It preserves margins without capital risk. And when the labor pool is continuously replenished by population inflows, the second option remains attractive indefinitely. Canada's business investment per worker has lagged the United States by a significant and widening margin over the past decade. Canadian firms are not investing in the equipment, software, and process improvements that would allow their workers to produce more per hour. The continued availability of relatively affordable labor reduces the urgency of doing so. The result is an economy that gets broader without getting deeper. There is a number worth sitting with. In 2023, Canada's population grew by approximately 3.2%, one of the fastest rates among wealthy countries. In that same period, Canada's real GDP per capita contracted. The United States, which grew its population at a much slower rate, saw real GDP per capita increase meaningfully. Canada had more people. Americans had more output per person. And compounded over 5 or 10 years, that gap describes two fundamentally different trajectories for ordinary households, for what people can afford, for how much their wages will buy, for whether they can accumulate savings or merely service debt. Growth without prosperity is not growth. It is a measurement error that has been allowed to stand because too many institutions benefit from allowing it to stand. The fiscal dimension of this trap is one of its least visible features, but it may be the most durable. When population growth accelerates, government revenues accelerate with it. Governments see this revenue and, over time, incorporate it into baseline spending plans. New programs get launched, Existing programs get expanded. Commitments are made that are calibrated to a continuing population trajectory. Now, the population trajectory is not just an immigration policy preference. It is a fiscal assumption. Reduce immigration, and you do not just get fewer people. You get a gap between the spending commitments already made and the revenue now available to fund them. That gap has to be closed through higher taxes, service cuts, or borrowing, all politically toxic. The incentive to maintain high intake levels is now embedded in the government's own budget math. This is how a choice becomes a constraint. Consider a household in the eastern suburbs of Vancouver. 2 incomes, one in healthcare administration, one in logistics management, combined earnings around $140,000. In 2015, that income made homeownership in the Fraser Valley financially stressful but achievable. By 2023, a detached home in their target area has a median price above $1.2 million. Qualifying for that mortgage requires committing roughly 60% of their take-home income to housing costs. They have done the math. The math says no. They are not failing. The system is producing the outcome its incentives generate. A household earning what most Canadians would consider a successful combined income cannot participate in the asset class that has been the primary vehicle for wealth accumulation in Canada for 30 years. They are not the exception anymore. The dependency ratio argument deserves scrutiny because it is one of the most frequently invoked justifications for high immigration levels and one of the most quietly dishonest framings in the policy landscape. The argument, Canada's population is aging. Immigration solves this by importing young workers who expand the tax base and defer the dependency problem. What is true, immigration does add working-age people to the labor force. What is wrong? The dependency ratio problem is not solved by importing workers who will also age. The new arrivals of 2023 will be the seniors of 2060. Their health care needs will compound. Without productivity gains to generate the surplus needed to fund those future obligations, adding more people only spreads fiscal strain across a larger population without reducing it. The demographic solution is not a solution. It is a deferral that requires constant acceleration. The treadmill does not stay at the same speed, it speeds up. Canada competes for skilled workers with the United States, the United Kingdom, and Australia. For years, Canada was competitive, the immigration pathway was accessible, the institutions were stable, the cities were livable. But livability is not a fixed characteristic. It degrades under specific pressures. When housing costs consume 50-60% of a household's income, the city becomes livable only for people who arrived early enough to have accumulated equity. For a skilled immigrant arriving today, a software engineer, a doctor, a supply chain specialist, the math of Canadian cities increasingly competes poorly against American cities where wages are higher and career upside is substantially greater. Canada's emigration rate to the United States has been rising. This is not the dominant story in the immigration debate, which focuses almost entirely on inflows, but it is directly relevant to the productivity question. The people most likely to leave are precisely the people most capable of generating the productivity gains the economy most needs. Their departure is replaced numerically by continued inflows, and which preserves population counts but does not preserve what was lost. Picture a graduate finishing a PhD in computer science at the University of Waterloo. She is 28. She has a Canadian offer at $95,000. She has an American offer at the equivalent of $180,000 US, which, after taxes and cost of living, represents meaningfully more purchasing power, even accounting for Seattle's high housing costs. In both cities, home ownership is expensive, but in Seattle, her salary allows her to accumulate significantly more financial capital in parallel. She takes the American offer. She is not leaving because she dislikes Canada. She is leaving because the math is not close. The system replaces her numerically. It does not replace what she would have compounded over 30 years inside the Canadian economy. The central bank's position within this system illustrates the constraint with unusual clarity. When the Bank of Canada raised interest rates aggressively in 2022 and 2023, the secondary effect on housing markets was immediate and uncomfortable. Prices fell in several markets, political pressure intensified, not explicitly about housing, but about economic slowdown, business impact, timing of cuts. The bank cut rates, housing prices stabilized, and in many markets resumed their upward trajectory. The bank cannot maintain rates at levels that would produce a housing correction without triggering the financial instability it is mandated to prevent. Its tools are constrained by the very vulnerability they would need to address. This is not incompetence. It is the predictable behavior of an institution operating inside a system that has made housing the load-bearing beam of financial stability. You cannot pull the beam without examining what is resting on it. What is resting on it is the balance sheet of every major Canadian financial institution, the retirement savings of several million homeowners, and the fiscal foundation of every major Canadian municipality. Stability preserved, correction deferred, costs externalized to the households that cannot participate in the asset class being protected. There is a historical comparison worth making carefully. Japan in the 1990s chose a specific response to its asset bubble: suppress volatility, protect incumbent financial institutions. Let's accept a generation of stagnation rather than allow the correction that would have been economically necessary and socially brutal. The result was not collapse, it was compression, gradual, decades-long grinding compression of dynamism and productivity, and of the expectation that the next generation would materially outperform the previous one. Canada is not Japan. The specific mechanisms differ, but Canada is suppressing volatility through continuous population inflows that prevent the housing correction that would rebalance the economy, that sustain aggregate GDP numbers while per capita metrics erode, and that give every major institution a reason to continue rather than correct. The choice is structurally the same: short-term stability purchased at the cost of long-term dynamism. Should Japan's lost decade became 2 decades, and then 3. The intergenerational wealth transfer dynamic the system produces deserves to be named precisely. Young Canadians who want to buy homes are told that the path to ownership increasingly runs through parental equity, the bank of mom and dad, inheritance anticipated and deployed as a down payment while parents are still living. The primary determinant of a young adult's access to housing wealth is not their own productivity, education, or labor market success. It is whether their parents happen to have bought a house before prices reached their current level. The person who bought a detached house in Toronto in 1995 and watched it appreciate by over 1,000% did not work harder than the engineer who graduated in 2015 and cannot enter the market. The system redistributed wealth from the second person to the first, not through any meritocratic process, but through constrained supply and population-driven demand. The stratification compounds across generations. The children of owners remain owners. The children of renters face a market that becomes more hostile with each passing year. Picture a neighborhood in North Edmonton, modest detached homes built in the 1980s, the kind of place where tradespeople and government workers have historically built stable financial lives. Over 3 years, the neighborhood shifted. Rents in nearby apartment stock rose sharply. Several houses converted to high-occupancy rentals. The longtime homeowner on the corner has seen her property value rise substantially and feels correctly wealthier than she was 5 years ago. The tenant sharing a 4-bedroom house with 3 other adults 2 doors down is spending more on rent than the homeowner spends on her mortgage and is accumulating no equity. Both of them are inside the same system. It is treating them very differently. The system's persistence is not explained by incompetence. Incompetence, once recognized, generates correction. What generates continuation is alignment. The major financial institutions are not lobbying for housing affordability. The municipal governments are not leading campaigns for aggressive supply increases that would compress their tax bases. The federal government is not voluntarily highlighting per capita GDP stagnation when aggregate GDP provides better headlines. The universities that expanded enrollment dramatically on the basis of international student tuition are not arguing for a reversion that would crater their revenue models. Every actor behaves rationally inside the system as it exists. The system rewards continuation. Continuation erodes the position of people not yet inside the asset class and consolidates the position of those who are, not through malice, through ordinary institutional behavior in response to ordinary institutional incentives. That is the most precise definition of a trap. Not a situation designed to harm anyone, but one that has evolved to the point where the mechanisms of harm are indistinguishable from the mechanisms of normal operation. What does adaptation look like for a generation of Canadians who have internalized the new parameters? It looks like delayed family formation, not because people do not want children, but because children require space and stability that the housing market no longer offers to non-owners. It looks like extended cohabitation with parents, not as a cultural choice, but as a financial necessity. It looks like career decisions made on geography rather than aspiration, staying near family equity rather than following opportunity. It looks like a retirement plan built on the assumption that homeownership is not available and that other vehicles will have to compensate for the absence of the wealth-building mechanism that defined the previous generation's financial security. None of these adaptations are catastrophic individually. All of them represent a meaningful downward revision of what the economy can offer the median household. And all of them feed back into the system in ways that compound the original problem. Delayed family formation means fewer children, which deepens the dependency ratio, which justifies more immigration inflows, which sustains housing demand, which keeps prices elevated, which further delays family formation. The trap loops back on itself. Canada is not heading toward visible collapse. The GDP number will continue to rise. The cranes will keep building. The press releases will keep describing a dynamic, growing country. What is happening instead is quieter and in many ways more durable than collapse. It is normalization, the gradual settling of expectations into a lower position. The acceptance, not announced but absorbed, that the system on offer is not the one that was promised. Some will navigate this by owning early, by having entered the market before the current pricing structure was established, by inheriting equity, by positioning within the finance and real estate sectors the economy has elevated above all others. Their trajectory remains positive, their retirement funded by appreciation generated not by their own productivity, but by constrained supply and policy-supported demand. Others will adapt by revising expectations, a smaller home than their parents owned, a later family, a career path chosen partly for geographic flexibility. These are not catastrophic lives, but they are lives lived at a lower floor than the system promised when the promise was still plausible. And some will simply leave. They will follow the math to countries where the income-to-housing ratio is less predatory, where the career upside is greater, where the sense that the system is working for them rather than extracting from them is still recoverable. Canada will count the arrivals. It will not adequately count what is being lost in exchange. The system has already made its choice. It chose price stability over affordability. It chose aggregate growth over per capita advancement. It chose the interests of asset holders over the prospects of asset entrants. These choices were not made in a single moment, but through thousands of individual institutional decisions that each made sense on their own terms and together composed a trap. The only question remaining is not whether the trap exists. The only question is whether you're still waiting for someone to open it, or whether you've already started doing the same math everyone else has done, and arriving at the same answer.